All right, highlight today is going to be a little math equation with position types. We've seen it down in here after 9:30. Told the group, told everybody what? If you're bullish, that's got to get you long. Why? Because it was a seller who, let's say a big seller, who is short. And the market sees or feels that selling, but doesn't go down. Now, we don't know it's going to creep all the way up to here, but we do know in real time what a seller might make if he's short turns into a buyer. When a seller gets short, when a seller is a seller to open a short, he turns to a buyer. Another thing happened in our puke tool. You can kind of see it with this green sticking out right there. That longs puked. So when there's a sell stop, generally that comes in, which is a seller, right? Sell stop is a sell order. And it gets along to puke, which means cover a position. Puke is slang for covering a position. Guess what they are no longer? They're no longer a seller. So they don't equal seller. They're no longer a seller. This is the dynamic that you want to go up. You want more buyers, and you get that with shorts opening up a position. And you want less sellers, and you get that with longs covering or puking their position. More buyers and less sellers, that's the recipe to go up in the price of a house, the futures, oil, S&P, NASDAQ, a stock. It doesn't matter. More buyers, less sellers makes price go up. The probability becomes really high. So that equation I just erased, it's important to understand like the back of your hand, which we have laid out on the website coming within the next few days, a real real kind of simplistic way to understand the governing principle of trading. And that is, why and how does actually price move? And it's this idea of positions being opened, positions being closed, and how the market reacts. Because real time is everybody's weakness that gets into trading. Even when you get consistent and start to rely on pulling money out of the market weekly and monthly, you're always working on your real time. You're always working on a better way to see the same thing. You're always working on location. And location is your ability to read the real time. The better locations you're picking, the better you're trading, period. I don't care if your opinions stink. If you're picking good locations, you're able to get out of trouble and maybe even make money and be wrong. So if you're picking good locations, you are trading really good, even if your opinions are dead wrong. Meaning, when I say opinions, you think price is going up. It doesn't, but you pick good locations and you keep yourself out of trouble, or your risk is lighter. And again, you could be right and lose money. You could be wrong and make money. That all has to do with defaulting back to location. Stay safe. For guys watching this in real time, whether it's on YouTube or your room, guys, 1 o'clock, we'll be in the Discord room for the Fed statement, 1 Central.